Dinshaw Irani joins us. Let's say hello, good morning, and happy Holi to him. You've played a lot of Holi, is it?
I got a bad cold also.
How have you been, my friend?
I mean, okay, how's you been, Nikunj? And a very good morning to you, yourself, and the viewers. I mean, your team and the viewers.
I'm surprised you managed to agree for the interview. I don't know. I just had a thought that you may be off to Goa or maybe one of those luxury destinations. It's a truncated week. You're really working
So
hard.
I leave that to Samir.
Okay, we've had a bit of a mid-air turbulence in the market in the last couple of days. Do you think markets are stable now? Has the storm come and gone?
Actually, Nikunj, we've taken a very proactive call on the market, saying that we believe that the markets are going to be fairly volatile. The turbulence will continue at least in the coming quarter. If it extends into the next one, also we won't be too surprised. So basically, next couple of quarters of fair amount of turbulence, and the whole reason for that is that we believe that starting from the March numbers, I mean the quarter numbers, we don't see them to be that exciting. I mean, in fact, we've been talking to a lot of corporates and markets and stuff like participants and all that. We've realized that there's fair bit of weakness in demand in that quarter itself. In fact, if you remember, the end of season sale started sometime in December itself. Normally, it doesn't happen that way, and that really set us wondering of why is there an inventory build-up and all, and we realized that that's happening along the way, and that's why we became cautious for a bit. And so the March quarter numbers will be the first ones, I think, after 6 consecutive quarters of growth, that one may see some kind of cuts getting built in into the earnings per se. And if rule doesn't pick up, even the June quarter doesn't look that exciting. So these are a few factors that has put us on a cautious note, and that's why we are being a bit more cautious in the market.
When you say you're cautious, how is that different from, let's say, what your earlier strategy was, let's say last year, where you bought into mid-cap stocks, you bought into consumer tech, fintech. That time you were bullish, now you're cautious. So has your portfolio changed because of that?
Yes, it has. In fact, the consumption space, you'll see quite a few changes. I mean, quite a few changes have happened. We've reduced some weight, we've moved out of some, and that's why, in fact, we've been very clear. But however, in the consumption space, the weight may not look very different because we become. I mean, there are certain pockets within, like tourism, hotels and tourism, which looks very exciting to us. And I think that is the space where we may have increased our weight uh, in the interim as such. So that's why overall there may be some replacement happening there, but that's a space that we remain fairly bullish on.
Right. Dinshaw, last we were chatting with Samir, he said that it's not the elections, that's pretty much in the bag. The market's also priced. What happens in the next budget, which is going to be critical in terms of a directional move for the markets. You think the elections up next is pretty much par for the course now? The markets have already assumed what the outcome is going to be, and that's going to be continuity?
Yeah, I think so. I think that's pretty much in the bag. I mean, one can keep arguing on the number of seats that they'll be able to get, but the fact is that it's in the bag for the ruling coalition per se. However, there may be some amount of I don't know, disappointment or euphoria around that because normally it happens, right? Elections are one event that happens once in 5 years, and there's a lot of rumors flying around, a lot of people giving out their thoughts. So it's going to be fairly choppy around that time also. However, don't forget that immediately after the elections is going to be the central budget, which is going to be presented. I think sometime in June end or July beginning, and that will actually, as Sabir has rightly pointed out, I think we believe that that is going to set the trend for the next couple of quarters per se. So let's just keep our fingers crossed.
So let's say from April to July or April to August, when budget is not going to be out, how do you see the market moving?
So basically, we could be very clear that even so April quarter itself, I mean the April to June end or whatever July, if you will, that quarter itself is going to be fairly choppy and volatile. We're not looking at a big correction, but we are looking at quite a bit of volatility in the market. And frankly, I mean, when there's a volatility getting built in and it's fairly wide volatility. I mean, you've seen that in the past. I mean, you saw that in the month of Feb, you saw that in the month of March, right? That is when you want to have a slightly lower beta in your portfolio, if you will. So basically, you try and fall less, but try and capture the upside to an extent. I mean, don't be so lower beta that you don't not able to capture the upside too. So partake in the upside, but do try and conserve on the downside, because once you conserve on the downside, there's no parallel. I mean, you can't. Whoever is beta 1 plus will never be able to catch up with you there. So that's the kind of portfolio we're trying to develop out here, and that was the main reason why we brought out a balanced advantage fund, because we wanted to have a low beta offering, which can be easily managed. The beta in that portfolio can be easily managed by way of balancing your equity exposure. While in a long only, the only way you can balance is by taking out the high beta names and just remaining there. So that way you have to be invested. So that's the reason why we brought up that.
What are you doing to your industrials and positions in your power stocks? Say, the large cap industrials, some of the power generators you have in your portfolio have done phenomenally well. There are certain sections in the market now believe that since the stocks have done very well in the last 6-8 months, 1 year, they are kind of baking in a lot of positives which lie ahead. Are you booking profits there as well?
So basically, one call that was, by the way, we only one power generator, which is, it's a PSU. So the one call that we've taken is that if the government is focused on, I mean, the next budget, basically the call is on that, focused on, say, the capex cycle and infra play, and they want to spend a lot on defense and stuff like that. One way of bringing in the money is through divestments, right? And that will be a very easier way for them to do that. And that's why we believe that that's one area that you need to. So not only that, we are also into. I'm saying not only power utilities, but we're also into the oil and gas companies. We upped our stake there in this recent volatility that one saw. We added to those names also, because that's the call that we've taken. Even after this run up, I think there's fair bit of value left in the PSUs per se, and that's why we remain there. In fact, we increase our weight.
Are you revisiting IT, because most of the IT companies are now talking about worst is behind, order book has started, valuations are not that stretched? Are you I can see you if you're shaking your head. So the answer is no.
No, definitely not. I think the worst is, so you saw the Accenture results, right? You saw their guidance also. It was obvious that I think everybody's missing the wood for the trees. So that, because frankly, I mean, there's a structural issue here. There's a fundamental issue out here, and the issue is. And by the way, if you had heard the sound bites from that analyst call that they had, normally a management doesn't use things like. We're having a tough time closing deals. It's taking much more longer. The smaller deals are off the table totally. We're only talking about big transitionary deals and stuff like that, which is mainly back-ended revenues. You don't hear such sound bites on the regular call if it's a bullish call, right? So it's obvious that there's a intrinsic problem out here, and that problem cannot be solved mainly because the interest rates are getting cut. Because if the interest rates are getting cut in the US and they're getting cut aggressively, we're quite clear that there's a slowdown happening in the US, and that's why they're getting cut. And the smaller deals are the ones which are really the discretionary deals, which are not happening. That's where the margin is. So, and anyway, you can make out from the kind of manpower hiring which is happening in the IT space, there's hardly anything happening there. So it's obvious that they have an issue. And frankly, I think our analysts are becoming more bullish than the companies on the stocks, I suppose.
Are there any other pockets, Dinshaw, where you're a little cautious right now and the last 2 odd months would have eased off, especially when it comes to small and mid caps?
So basically, the one which we've been fairly cautious on has all along been, obviously, IT was one. FMCG is another space that we are being very cautious about, because we also believe that there again, there's going to be a fair bit of pressure. Though they've already enjoyed a fair bit. In fact, if you remember the third quarter numbers, December quarter numbers, the top lines didn't grow at all. It was just margin expansion which really supported them, and still they're disappointed. I think that also is out of the way now. I mean, March quarter will be a one where you'll see really a large bit of disappointment building in. Paints is another sector that we've been fairly cautious on all along, and that is proving to be right. In fact, in our long short portfolio, we in fact short paints as such. So these are a few sectors that we be cautious. Even in the consumer discretionary space, there are pockets, and you've seen in our portfolio, we took out names which are in the apparel business and all that. So that is out for us. There again, the white goods business is not doing too well as such. I mean, there's no offtake happening out. So these are the few spaces where we've been very cautious and we've been avoiding these spaces.
You bought into oil marketing companies, I distinctly remember. Is that trade still on?
Yes, yes, definitely on. In fact, that's what I said, that we in fact added to the names. Once the correction built in, we added to the names, and we are very comfortable here. In fact, even after that 2 rupee cut or whatever that cut was, which was undertaken, it was mainly to get them in line with the long-term averages on the margins per se. I mean, they're historically the regular marketing margin that they had was around 3 rupees. They were earning around 6 odd rupees as such in margins, and obviously the cut was to get them in line with those margins. And that's what we realized. We said, okay, now it's not about pandering up to the election season per se, but it's mainly to get them back into regular business mode. So they were allowed to earn these windfall margins just to make sure that they back up on their profits per se before they take a cut, because they did suffer earlier as such. So we are very comfortable here.
Well, IT, we say, okay, there is a problem, look at Accenture numbers. But if I look at AI and look at what is happening to Magnificent Seven, how does one translate that rise or the kind of market cap some of the Magnificent Seven are commanding for Indian investors? I mean, is there a correlation?
So anyway, Nikhil, the fact is these Magnificent Seven, I mean, apart from the chip manufacturers, they're mainly platform suppliers. I mean, they're platform companies. We are IT services. We are known for IT service rather. It's not platform as such. And mind you, even in those Magnificent Seven, the ones which are into AI have done phenomenally well. In fact, if you see this year to date, the main part of the seven, I think only three has participated, three or two, if I remember the number right, have participated in the rally which has happened in the S&P as such. And that's mainly because of their AI focus per se. And that's what I think is driving the world forward. Our belief also is very clear. We're very gung-ho on AI, but I think our domestic plays are not at all, I think they're too much back in time on AI per se. And that's why it's not exciting us today in the domestic space, but our offshore fund has really partaken in that rally.
All right, Dinshaw, appreciate your time. Glad you could join us, and thank you for your valuable